Back to Market on Call. It's time for a big picture discussion about the week ahead with Mr. Collin Martin, Director and Fixed Income Strategist at the Schwab Center for Financial Research. Collin, starting with Jerome Powell next 2 days. Anything that can move the market?
Well, we'll be seeing if he provides any hints about what the timing of the first rate cut might be. We're already in July and the next meeting's this month, so it seems highly unlikely that the Fed will be cutting rates. But all eyes are now on the September meeting. And given that we've gotten kind of a slew of soft data, both from hard economic data and soft economic data, and that's pulled forward expectations for September and the idea of 2 cuts this year. So we'll be paying attention to how Powell addresses that. I'm sure he'll try to toe the line, as he has over the past number of weeks and months. And most officials have said the same, where they want to see more data, more good data, and really believe that inflation is consistently moving towards its 2% target. We've gotten a handful of reports that suggest it is. So we'll see if he kind of provides a hint that they've seen enough, or maybe an idea of how many more reports that they'll need to see before they're more comfortable.
Okay. And is there any, there's a non-zero that something could happen in July, but it's like effectively zero, right?
I'll say as close to zero as you can get without right. saying zero.
Okay.
It's just highly unlikely right now, and it's in line with what the Fed's saying. The data we've gotten recently has been objectively good on the inflation front, but the Fed has been steadfast in its commitment to bringing it down. And I think they're probably a little spooked from the first quarter when we saw some stronger than expected numbers. So to prematurely cut only to see, let's say we got one high number over the next few months, they'd probably second guess themselves. So no need to jump the gun right now. And I think they're feeling better, just waiting another month or two before they actually go ahead with that cut.
Got it. Collin, how does the move in crude oil over the last couple of weeks factor into your thinking about inflation and therefore bonds? Some were kind of attributing that spike in yields we got now a couple of weeks ago to WTI. Obviously, the yields came back down, but it seems like something maybe worth thinking about.
I'd say worth thinking about at the margin. I mean, if you look at the movement in 10-year Treasury yields, yes, it does tend to ebb and flow with the level of oil prices. We're not focusing on that too much right now, mainly because the inflation data that we're paying attention to and that Fed officials are paying attention to excludes volatile food and energy prices, so the price of oil. The Fed knows they can't really affect that or impact that. So if we continue to get good data, and let's say we get a good report with the CPI this week, even if we see oil prices trickle a little bit higher, I don't know if that would necessarily pull long-term yields higher, because I think all eyes will be on the potential for the Fed to cut rates as opposed to what the oil market might mean for long-term yields. Okay.
All right. So then if we're thinking about the kind of real market mover then potential this week, I mean, it's inflation, right? It's CPI. After the last reading for that particular metric was pretty encouraging. Is the standard moving a little high here? You think the market wants to see that continued compression of prices?
They do. I'd say the markets are probably priced for a low number. If you look at what consensus expectations across the street, it's for a pretty tame number. I think on a headline basis, year over year, expectations are for around 3.1%. Core, I think, is 3.4%. So the markets are basically pricing in a continued disinflationary trend, both with the CPI and the PPI. So I'd say the risk is probably more to the upside. And I think that's because that's the concern. If there's something in there that spooks Fed officials and maybe pushes off the timing of rate cuts, that could pull yields higher. That's not our expectation. We see plenty of signals that inflation continues to move lower. One, in the inflation data. Two, in inflation expectations and surveys like the ISM manufacturing and services indices. And then the labor market. The labor market continues to come into more balance, as we saw last Friday. And as that continues, as the unemployment rate trickles slowly higher, we think inflation should continue to move a little bit lower.
Okay. All right. So, Collin, lastly, is if we talk kind of the other options besides treasuries in our bond portfolio, give us a kind of fresh update, second half, what you guys like, what's the strategy?
Our strategy continues to be extend duration. So Oliver, you're probably sick of hearing us say that because we try to pound that table pretty hard every time we're out here. But we think it's important because for individual investors who are holding bonds, if you're in very short-term investments like treasury bills or money market funds, that's a short-term investment strategy. And we think bonds are really better held as a long-term investment. So we've been suggesting our clients move out on the yield curve and lock in some attractive yields with more certainty. Now, that's difficult with an inverted yield curve. So to your point, Oliver, our theme for the second half of the year is thinking beyond treasury securities. So whether it's mortgage-backed securities, whether it's investment-grade corporate bonds, or some combination of those, which includes the broad aggregate bond index or a strategy that tracks that, you can get yields of 5% or more by moving further out in the curve with these investments. They have a little bit more interest rate risk, so their prices can move a little bit more in the secondary market than short-term investments would. But if you're looking for income and you're looking for yield, we think there's a lot of high-quality ways to do that without focusing just on the treasury market.
All right. Thanks for the chat, Collin. We will speak this week and be watching bonds closely. Thanks, Mr. Martin, Director and Fixed Income Strategist at Schwab Center for Financial Research. We got the